The narrative at the start of 2025 was clear. The new administration would cut regulation, extend tax cuts, and use tariffs strategically. It might even give the markets a Trump put if things started getting shaky. After 2 straight 20% plus up years for the S&P, optimism abounded for another strong year. Fast forward to now, though, and the script is in rewrite. The future is less certain. Former leaders are falling behind, while new stocks and new sectors are moving ahead. And gold, an asset that thrives in uncertain times, just blasted to an all-time high above $3,000 an ounce. So what comes next? Where are the markets headed? I've convened a Money Show Market Roundtable of top financial experts to get you the answers you need. They're Kenny Polcari, Chief Market Strategist at Slate Stone Wealth, Tom Hayes, Founder, Chairman, and Managing Member at Great Hill Capital, and Jim Bianco, President and Macro Strategist at Bianco Research. Gentlemen, welcome. Guys, I'm going to start just by asking a super scientific market question, and that's frankly, what the heck is going on? We've got volatility through the roof. We've got the big tech and Bitcoin, which we're doing great. Those have tanked. Gold at, topping $3,000 an ounce, and geopolitical worries back on the board. It's a lot of things on the table. So I guess, Kenny, I'd want to start with you. What are you seeing out there in the markets, and what is going on here?
I think it's the great reset, right? Because I think that we got way too bullish, way too excited about what was happening, what was going to happen with the new administration, what was happening in technology, what was happening in investing. And, we just got well ahead. The market got well ahead of itself. And now the policies that, the market rallied right after the Trump election, and then it started to fade on fears that, maybe they're not going to get the tax cut. Maybe they're not going to get, they're going to get blocked along the way. And so add that to the tensions about tariffs, add that to the tensions about geopolitical drama happening around the world. And suddenly you get this reset in prices, which, by the way, I don't think is a bad thing at all. I think it's welcome. I think most people that have been that are in this business look for this as an opportunity, right? It's kind of overdue. We haven't had one in a while, a 10% plus correction in a while. So it's overdue. I don't think it's anything to panic about. I don't think the Fed's going to change anything at their meeting this month. I actually don't think there's going to be a rate cut at all this year. But I'm in the camp that there's no rate cut unless the data changes so significantly that causes me to change my mind.
Yeah. Jim, I want to touch base with you here. I mean, you and I spoke right after the election, had a lot of thoughts on there. How has your thinking kind of evolved given what you've seen in the last few months since then?
I'm largely in agreement with what Kenny said. I think that, he called it the reset. I'll call it the realignment. I think what Trump is attempting to do here, which people are starting to try to get their head around, is he's not tweaking at the edges here. He's not playing, he's going right at it and trying to realign the global world order that we've seen for the last 80 years. And you can make a case that it needs to be realigned for a lot of reasons. And the biggest driver is the amount of debt that we have in this country right now. We cannot continue at this rate. So whether it's tariffs or demands that you pay for security, this is something that people are starting to realize is going to happen. It is going to happen in a big, bold way. And you're starting to see that in markets and with the volatility that you've seen. Now, it's also happening at a time when the markets were fully valued, if not overvalued. And that's also contributing to what we're seeing. But I'll agree with what Kenny just said, too. This is the first 10% correction since October of 23. We get these about every 18 months. It doesn't necessarily mean that, something bigger or more nefarious is going on. Yeah. It is going to be a volatile and an uncertain period. And it might be a period of, lower returns. Look, we've gotten all comfortable with the idea that the S&P owes us a 20% return every year. Maybe we're going to get a 5% return this year or something along those lines. So I think what we've started to realize post-election is this is a bigger deal than just, I'm a president and here's my agenda and I want to try and do 2 things so everybody remembers me in 10 years. Now, this is a wholesale realignment that he's going for right now. And it's just starting to come into focus that that's really what his larger goal is.
And I want to get back to you about your sort of Mar-a-Lago Accord is how you put it in just a minute, but I want to go to Tom first. Tom, I know your big bottoms-up analysis valuation of individual companies, but you got to look at the big picture here too. What are your thoughts on just how things have changed since the first of the year till now?
Well, I think this is pretty standard, Mike. This is what we see pretty much every 4 years. Post-election year, you see some weakness in February through mid-March, and then you start to find a bottom. And why is that pretty uniform going back, 100 something years, is because people want to get a sense of what the policy is. And it doesn't have to be good policy. It just needs to be known policy. And I think that's what we're grappling with Trump right now. But I say to many people, welcome to Trump 2.0, same as Trump 1.0. New day, new headline, new tweet, new volatility, resolves higher over time. And what we saw last week is a big flush out, record selling by hedge funds. That's a contrarian indicator. A lot of momentum followers there, over leverage. Retail investors bought record insurance, record put buying after the house was already burned down. You want to buy those insurance premiums before the fire starts. So you can't make that up. Then you had the largest drop in U.S. equity allocation on record in the Bank of America Fund Manager Survey, which we saw this week. So I think we're finding a situation where we can go in and buy stocks. As for the Mag 7, at your events towards the end of the year, I was saying the theme was going to be a shift out of the Mag 7 into the unmagnificent 493, and more importantly, into international. That's played out as anticipated. We think that theme will continue. And Mag 7, you got to look at two things. Number one thing no one's paying attention to that I've seen is the Japanese carry trade unwind, okay? And all you need to do is look at 10-year JGBs, and what used to be free hot money and now has a cost. 10-year JGB yields are at 20-year highs. Those have continued to creep up aggressively in the last 4 weeks. And as a result, the most impacted part of the market has been the Mag 7, where all that hot money has been parked. So I do think that, yes, we are due for a technical bounce. Maybe Mag 7 will trade back up to the top of the range, but I think the theme for 2025 will continue. Mag 7 will underperform relative to 493 and dramatically underperform relative to international, as we've seen.
Yep. Thanks, Tom. Kenny, let me go back to you. I think you're in one of your recent columns, you said something about people have to get comfortable by being uncomfortable, and you're not looking for this kind of V-shaped recovery. Can you talk about that for a little bit?
Right. So I think what we've seen over the last 3 weeks, when the market really started coming under some pressure, is that investors tend to get very uncomfortable because prices going down. They start to worry about their portfolios and the stocks in their portfolios, and the first reaction is always the wrong reaction, right? They hit the sell button and they sell good name stocks that are just under some pressure, not because the thesis has changed, but because kind of the cycle has changed, which is affecting the broader market. But that's exactly the wrong thing to do. At the minute they get uncomfortable, they immediately hit the sell button and they try to start over again. As a long-term investor, that you have to kind of get used to these cycles. And look, to Jim's point, to Tom's point, it's been a while since we've had one, and people were always used to these. In the last 2 years, we had 25+% returns on the NASDAQ and the S&P, and people are starting to think that that's normal, when in fact it is not. And so a return to 8 to 10 or 10 to 12 if you add in dividends is probably where we are going. This year we may underperform a little bit, but you still have to stick to your plan. You have to try to be comfortable in an uncomfortable situation and focus on the long term, right? I think that that's a very difficult thing to do for a lot of investors, right? But it is something that if you've been in it long enough and you've followed your plan and you've taken advantage of the chaos that stuff like this can create, then in the end you're always better off, right? But again, it goes to knowing what you own, why you own it, and whether or not the thesis of the story has changed. If suddenly you bought a stock on one premise, and that premise changes, then there's a reason to have a conversation. But if the premise itself hasn't changed and the stock's under pressure just because we're in a cycle, there's no reason for an investor to get, set their hair on fire and jump out the window. It's completely unnecessary.
Jim, let's talk a little bit about this Mar-a-Lago Accord approach. I mean, I think it's instructive because everybody was a lot of people on Wall Street were looking for, Trump 2.0 to have that Trump put, just like we had during Trump 1.0, but that doesn't seem to be the case now, right?
Yeah, the put exists in the 10-year yield right now. It does not exist in the S&P 500. So the Mar-a-Lago Accord, just so everybody knows, it's a riff on Bretton Woods, which was the major currency realignment in 1944, was named after the resort that it was done in, which is called Bretton Woods, which still exists in New Hampshire. Plaza Accord, 1985, was named after the Plaza Hotel, which was a currency realignment. So they named them after the hotels and the resorts that they do them. And that's a riff on Mar-a-Lago Accord. So there is actually no Mar-a-Lago Accord or a plan to do one. It's more of a concept. It was written by Stephen Mirren, who's now the Council of Economic Advisors head for Donald Trump. And it was about restructuring the global financial system. And let's start with a basic question. Are we in the middle, or were we in the middle of a crisis? $36 trillion of debt, $7 trillion budgets, $2 trillion deficits, $2 trillion trade deficits. Was that unsustainable? Well, there's this guy named Jay Powell, and he runs this organization called the Federal Reserve. And in December, he gave a speech and said, all those numbers are unsustainable and we need a change. And that's the driving force behind what Trump is doing. He's saying the status quo can't hold. So when he gets criticized, like by the Economist magazine, it has a picture of him holding a can of gasoline and a lit dollar bill about to torch the world. And their argument is just stop. Stop and do what? Go back to the old status quo? The argument is we can't go back there. We have to do something about this debt. So what is it they're trying to do? They're trying to use tariffs to correct the trade imbalance, bring down the value of the dollar. Now, you can argue that might not work. But if you want to argue it doesn't work, what's your alternative? Just go back to $2 trillion deficits and endlessly funding wars in other countries until the end of time? Or, their other argument is that why do we have $36 trillion of debt? Well, a lot of it was from security. We fought communism, we fought terrorism, we kept trade routes open. So let's get the rest of the world, our allies, to start paying for it. And they're agreeing to it. And the day we're talking, Germany did something that's probably the most important thing they've done since reunification. They've lifted their debt brake. You and I might know that as like a balanced budget amendment, and they're going to deficit spend like crazy to try and ramp up their defense. So this is already having huge impacts, and that's why it's having such impacts on the currencies, on interest rates, and on stocks. So is there a put out there to answer your first question? Yeah. As I joked, it's on the 10-year yield. It's on the dollar. It's trying to change those relationships. And as far as the stock market goes, Scott Besson said we might have to detox. Trump said in his State of the Union address there might be an adjustment. These are euphemisms for get used to what we've been seeing. We're going to see a little bit more of it, but it doesn't have to be catastrophic.
Got it. Tom, I want to pivot to the point you made earlier, which was just, the outperformance of foreign versus U.S. markets, and in particular a market you've talked about for some time, which was China. The narrative after the election, even before the election, was strong dollar with the Trump administration, buy U.S., not foreign, buy crypto, all of those things that were sort of the narrative. And that for a while it worked, but that's all been blown up. So what are your thoughts there?
Yeah, I mean, it's interesting. You and I were on talking about just this, and I said, look, in 2016 when he was elected, dollar rallied, yields blew out. Right after he was inaugurated, all of that reversed. And I think to what Jim is talking about this Mar-a-Lago Accord, international dramatically outperforms when you see a weakening of the dollar, a lowering of the 10-year yield. I think this time will be no different. When you look around the world, China at 13 times earnings, emerging markets at 15 times earnings, U.S. at 21 times. The other thing about Mag 7, I talk about is earnings growth. Certainly I talk about the unwind of the carry trade in terms of the hot money coming out, but it's actually backstopped by earnings. Growth has decelerated from 33% last year to 16% this year, and the multiple hadn't re-rated. So we're going through that. And why is the earnings growth down? Part of it's due to CapEx, which has yet to show a return on invested capital. We'll probably see that return over 12 to 24 months, but that investment also crowds out the thing that made these stocks great again, which was buybacks, record buybacks. And if you're spending all the money on data centers and NVIDIA chips, it's going to be a lot harder to buy back at the same pace that they had historically, which is why the earnings growth is decelerated, which is why the multiples need to re-rate. So when you consider the weighting they have in the S&P 500, to Kenny's point, I like the call 8-10% on the general indices. And I think there are going to be a lot of the 493 that are up double and triple. I mean, there are going to be unbelievable opportunities for stock pickers out there. And international, as you know, our largest position has been BABA. Took us 2 years to build the position. We brought our basis down. We started higher. $83 is at 145, and that's going to go over 200 over the next 12 to 24 months. And that's part of the international China theme.
guys are basically disagree about something, right?
So, one thing, to Tom's point, when you look at the other 493, look, the indexes are all down, right? The Nasdaq's down 9%. The S&P's down 4.5%. The Dow Industrial is down 2.5%. Yet, energy is up 6%. Healthcare is up 6.5%. Real estate's up 3%. Basic materials up 3%. Utilities up 4%. So there are certainly opportunities within the market, even if the indexes are telling you the shit's hitting the fan. There are clearly opportunities in other places of the market that people need to kind of expand their horizon. And to Tom's point, to Jim's point, we're going to see a pullback in the Mag 7. We should probably see a pullback in the Mag 7 because once again, it got way too stretched. It was a very crowded trade. Everybody was in there, including the cab driver. You get in the cab, and the cab driver wants to know what you're going to do next. That's when you know that you've hit the absolute top, right? The same thing happened in the dot-com bubble. You get in a cab, and the cab driver's saying, now he's trading all these dot-com names. It completely blew up. Now, I don't suggest AI is going to blow up because these are real companies doing real things. But I do see that everyone should welcome this kind of healthy pullback and opportunity in other sectors that we're seeing. I didn't mean to jump in on that, but I just had to get off my chest.
No, that's great.
That's good.
Once you dodge the stuff coming from the fan, is there like a favorite sector or stock or two that you like right here?
No, well, listen, healthcare for sure, and within the healthcare, I'm going to always go as an advisor, as a wealth advisor, to the biggest names in the sectors that you like, right? The ones that are going to be able to withstand the storm. So whether it's Johnson & Johnson or Merck or Eli Lilly, it could be in the healthcare, so it could be UNH. In the financials, it's going to be J.P. Morgan. In my case, J.P. Morgan, Bank of America are two names that I love. BlackRock, another name that I love in that space. And certainly utilities. Especially if we see rates come down, which I'm not really sure we're going to see rates come down, but if we do, utilities will certainly benefit. Utilities are also going to benefit because there's this massive energy demand. There's a massive demand for energy around, not only in this country but around the world. So I'm not into this, this waning demand and blah blah blah. Whether the economy is strong or weak, people need energy to survive, and businesses need energy to survive.
So let me riff a little bit. I mean, you've talked internationally. You mentioned Alibaba. Is there anything else that particularly excites you now? I know you've talked about some names at our past events, but we're getting towards the end of Q1, so I figured I'd see if there's anything new that's on your radar screen.
Look, I think Intel is the most underrated story. If they liquidated the whole damn thing today, you'd probably get about $22-23. It's trading at 25. Lip Bhutan was at Cadence Designs, which makes the software for all of these chip designers. Lip Bhutan became CEO of Cadence Designs in January 2009 after the stock was down 86%. If you'd put $1 million with this guy, by the time he stepped down as executive chairman 14 years later in 2023, that $1 million became $68 million. 68 bagger. This guy is a miracle worker. Intel needs a miracle. He's going to deliver, and he's not interested in partnerships or selling it off for parts. He's going to run this thing up the flagpole. And here's the thing. NVIDIA is not down because of lack of demand. NVIDIA is down because of lack of supply. TSMC is at capacity and only gives them $4 billion of revenue growth per quarter, which on a bigger base decelerates the revenue growth from 250% down to probably 30-40% by the end of this year. They need capacity. TSMC could say, yes, Mr. Trump, we're going to invest $1 trillion in the United States. The problem is it's going to take them 4 to 5 years to get to where Intel is with their fabs today. So love Gelsinger or hate him, he did one thing over the last 4 years. He set Intel up for success, and Lip Bhutan is going to come in and spike the football in the end zone as this chip production comes on board. Right now, NVIDIA and Broadcom are testing their chip in Intel's U.S. fabs. And from what we have gotten back through media, it's going quite well. This game is just beginning for Intel, for everyone saying, oh, Intel's going out of business. I mean, give me a break. They've done over $50 billion of revenue in the last 12 months being completely mismanaged. And now you got someone who can ride this horse to the promised land, and we're getting on with them.
And as an old school person, all I can do is reminisce about the Wintel days, right? In any event, Jim, let me ask you, since you approach this obviously with your bond ETF and so on, you're looking at different ways to profit in fixed income. You're watching what's going on in the dollar. What are some strategies you're looking at here?
Yeah. So one of the things I've been arguing, and this fits with a lot of what Kenny and Tom have been saying, is that for the next couple of years, this is going to be what I like to call the 4, 5, 6 markets. I think we're going to return 4% in cash. Kenny, I'm with you about the Fed's not going to cut rates anymore. I've termed tomorrow's meeting that we're recording the day before the Fed meets in March, the day before the most important meeting of the year. If they don't pull the trigger in May and the market's only putting a 20% chance they pull the trigger in May, they're not going to find a reason to cut rates. If all of this hyperventilation about tariffs and 10% corrections, and they can't find a reason to cut rates by May, they're not going to find a reason unless, as you pointed out, Kenny, unless something else comes along that we weren't anticipating that changes the equation. So I don't think they're going to cut rates. So you're talking 4% cash. I think the bond market is going to return you 5% for the next couple of years. Now, the reason I think the bond market is going to return you 5 is you're looking at the potential of getting your coupon, which the all-in coupon, when you include corporates and mortgages, is about 5%. Some years you'll get 8, other years you'll get 3. You'll average somewhere around 5% or so in the bond market. Stocks, I think that given the valuation in stocks, I've been using the argument they're going to return like 6% over the next several years. 6 is a little below average, but it's not terrible. And I've used the metaphor with stock market is that for the last couple of years, when you have 20, 25% returns, it's like sailing. I know nothing about sailing, but if you put me in a sailboat with a 25 knot wind, all I got to do is get the damn sail in the air and the boat's moving forward. You put me in a boat when the wind is 4 or 5 knots, now I got to learn to tack and trim and do all that other stuff. I can still get the boat to move forward, but it takes a little more skill. So to Kenny, your point, when the stock market's up 20, 25% a year and you come in and tell me utilities are doing this, energy's doing this, that financials, nobody cares. The damn thing's up 25%. Well, if it's up 6% a year, now we're going to start to care about that stuff. And the things that Tom's talking about with these stocks, no one cares when the index goes up 25%. They're going to care now that the market's going to go up 6%. You're going to have to learn how to tack and you're going to have to learn how to trim. How's the bond market fit in that? The bond market fits in that to the extent that the stock market is going to return you, the broad index is going to return you 6. There might be opportunities to do a little bit better. But I think the bond market's going to return you 5. It's going to give you most of the stock market's returns with less volatility. For a lot of people in a more conservative bracket, that might be all they want to hear. I'll get 80% of the stock market's returns. I'll get it with 40% of the stock market's volatility. Thank you very much. I'll take that all day long. I'm not looking for huge gains depending on their risk tolerances.
Well, I tell you, if you want to take up sailing, I hope you don't start in the Bay Area. That's a little bit rougher waters, and that's not training yield territory.
Exactly.
Guys, I have to ask about, I know it's not really anybody's particular specialty, but, gold here, 3,000, we keep going up. It's been one of the best performing assets. Any thoughts on, if this is just sort of one of those things you don't really worry about too much, or you think this move's got power behind it?
Listen, the move already has. It's up 25% this year, and we're only, 10 weeks into the year, and it's already up 25%. It was up 25% last year. I think it's a flight to safety. I also think it's huge central bank buying that's behind a lot of this move. But I do think that it is a flight to safety, and people are nervous around policy, right? They're not nervous around the economy. They're nervous around policy. They're nervous around Trump. They're nervous around the geopolitical stuff. They're nervous around, Russia, Ukraine, China, Taiwan. They're worried about the Middle East. And so I think that is behind this move in gold, in addition to big central bank buying. And I think it's still have legs to go.
I'd agree with that. I think that this move has got more legs to go. I think that if you're talking about an era of realignment and, uncertainty, I hate that word uncertainty, but there is some uncertainty. I just think that those uncertainty indexes completely overplay it. They're trying to tell me that this is a more uncertain period than 9/11 or the financial crisis. That's almost laughable to think that today is more uncertain than those periods. But there is some uncertainty in there that gold is a place that everybody's going. And what's interesting about the gold trade, too, is that you're not necessarily seeing it by the speculative elements of people just flying into GLD and the rest. There's been a gigantic demand to import physical gold because the buyers of gold want to own actual bars and they want to own warehouse receipts of those bars. It's a very different type of buyer than we've seen. That suggests to me it's a strong-handed buyer they're going to keep coming, and they're not looking to, flip this on a short-term trade. They're going to hold it for a while.
Okay. Well, I know we only have a couple minutes left. I want to make sure, for anybody watching, Jim is going to be joining us in Dallas and Miami. Tom and Kenny are going to be joining us at the Miami Symposium in May. Guys, if you have maybe 30, 45 seconds to just give a preview of what you think you're going to be talking about. Tom, maybe I'll go to you first and let you do that now.
Yeah, I think one of my segments is going to be how the uninvestable became investable. While we were building up our BABA position, everyone said it's uninvestable, it's uninvestable, it's uninvestable. We're going to talk about kind of market sentiment that goes into that, how you can see through the noise, look under the cover, follow the fundamentals. In the short term, the market is a voting machine based on emotions like you saw in the last 2 years in China. In the long term, it's a weighing machine based on fundamentals like you're seeing right now. And then we're going to talk about some, in the second segment, some year-end picks, year-end outlook, a lot of opportunities to make money in the second half of this year. So we're really excited to go down to Miami and deliver a lot of value.
Awesome. Jim, same to you.
Yeah, so I want to talk about the bond market and where does it fit into a portfolio in 2025. Now, we're all familiar with the phrase, Tina, there is no alternative. That's an old 2019 phrase when interest rates were at 0 to 1%. And the stock market was roaring ahead at reasonable valuations at plus 10% a year. But in 2025, with very high valuations and a struggling stock market and a 5% coupon now on bonds instead of somewhere under 1%, there is a solid place for a portfolio to have bonds in them, and that they will fit very well within that portfolio. And I want to also talk about the role of active managers, especially in bonds. We all know that the studies say that active management in stocks, usually the benchmark index will beat about 85% of active managers over a period of time, although I think that will be a little bit lower if we have lower stock returns. In bonds, it's more like 50 to 55% of active managers can beat the index. The index comes in about the middle of the pack. Bond market's got a different structure than the stock market. So active managers is been a time-tested strategy, and you've seen that in the marketplace. Probably the biggest number of new ETFs coming after the Bitcoin and crypto ETFs is actively managed bond funds. Everybody's rolling one out, and in full disclosure, I've got one as well too, and I'll talk about that as well.
Great. Kenny, anything big themes you think you're going to be hitting on? I know we're still a couple months out from May, so.
Yeah, no, well, I mean, the big thing for me is going to be, look, because we're going to be in May already. So looking into the summer, into the second half of the year, where I see policy going, not only Fed policy, where I see the administration policy going, whether or not, the impact that tariffs are potentially going to have if they haven't gone away by the time I get there in May. There's a potential that they go away, right? That everyone comes to the table and suddenly we're not even talking about tariffs anymore. But if we are, then we'll continue to talk about that, and then just planning a overall strategy as an advisor, long-term advisor, planning the overall strategy that include both of what Thomas and what Jim has said about planning and bond for the bond market and kind of the overall performance of what people should expect.
Got it. Well, listen, great. Guys, thank you. I really appreciate taking some time out. Tom, Jim, and Kenny, I know everybody's kind of all over the place geographically. Appreciate getting together for this market roundtable, and we'll see how things go between now and Dallas and Miami.
Thank you so much.
Thank you.
Take care. Viewers, Jim is going to be joining us at our Money Show events in Dallas in April, in Miami in May, while Kenny and Tom will be speaking at the Miami Symposium. Do not miss out on either of these events. You can find details on how to attend them in the description below. Gentlemen, thank you again for taking part in this market roundtable.